Today's episode is sponsored by Calamos. Looking for NASDAQ exposure, monthly income, and built-in risk management all in one ETF? Check out the Calamos NASDAQ Equity and Income ETF, ticker CANQ. That's CanQ, Ben.
Yeah, they spell it out for you, which is good.
CanQ taps into decades of expertise in options and alternatives to pursue upside from the NASDAQ 100 stocks while actively managing downside risk with fixed income.
It's a smart mix of growth potential, monthly income, and risk-adjusted returns. Since its February 13th, 2024 inception through June 30th, 2025, CanQ has captured 96% of NASDAQ 100's upside with only 65% of the downside across all market cycles. Ready to rethink your portfolio? Explore CanQ today and visit calamos.com/CanQ to learn more.
Welcome to Animal Spirits with Michael and Ben. You wrote a post last week. Some bubble questions. Did I grab the right post? Is this the top? Okay. Maybe it is.
The right one. Yep.
When did you write this? Was this prior to Friday?
I think I wrote this Friday. And you know, you have one bad day in the stock market and you feel like, oh, I need to change my whole thesis. But I think it's still, we talked last week about the melt up, and my whole thesis here is I don't think people are going to try to call the top. I don't think anyone's going to be able to do it. That's where I stand on this. And if they do, they're just going to be lucky.
Well, yeah, somebody will call the top, but
right. But everyone keeps trying to do it over and over again. And I don't think you can, if you've been saying it for 24 months, then get out of here.
Well, counterpoint. I generally agree. But people were bearish in 0506. Michael Burry famously was very early and very right.
Yeah, but I think that's a little different. That was like calling the housing market to crash. And I think if you're saying, listen, AI bubble is going to crash someday, like everyone has been saying that. No one can take credit for that anymore. Everyone said it, so no one said it.
Well, how about this? We discussed this last week, and we'll do it later in the show. Calling your shot, who cares, right? Like it's very easy to say this is the top without any repercussions.
Right.
Is anybody
going to saying it over and over again?
Right, but like making money, that's what we're talking about here. Is anybody going to successfully nail the top and actually?
Okay, that's the good point. Yes,
right.
Are you going to pull the John Paulson and actually profit from this?
Right. So I don't think the market will allow that for too many people. Again, get to that later in the show. But the chart that I pulled out, Ben, why did you choose the forward PE ratio? Because I guess you're saying like if valuation is your thesis, things are overvalued.
So Chart Kid Matt did this for me. I said, hey, I'm thinking about writing a post on picking the top. And he said, how about this? He said, look at how many times it looked like valuations had peaked during the dot-com bubble because they rolled over and they came back up and they rolled. And part of this is just the market rolling over, right? But the point is, how many people thought that was the top every time valuations rolled over?
Yeah.
And then they kept moving higher.
Yeah. Okay. So here's what I took away from this. I'm looking at, you have a table in here showing the bear market since 1990. And at the peak in 2000, at the March peak, the forward PE was only 22 times. Got me thinking, well, yeah, the forward PE was a bit elevated, but it was wrong because the E fell out through the basement. So I had Chart Kid make me a chart which showed what is the forward 12-month EPS versus the actual EPS. And you could see the bear markets happen when the earnings are way higher, when the projected earnings are way higher than what actually happens. You saw this obviously in the dot-com bubble. You saw this in the GFC. You saw this in 2020, as quick as it was. And that's all that matters here. So I don't care how high the forward PE gets. Now, at some point, it matters when it matters. And the higher you get, the less margin you have, the worse the downside is. But it doesn't matter until earnings actually disappoint.
Right. So this is a good chart because it shows that most of the time, estimated earnings and actual earnings are right in line with one another. And you're right. It's when people get ahead of each other. And as we talked about last week, the earnings are going to roll over almost concurrently with the stock market. So to your point, you have to almost wait for the earnings to roll over before you start getting bearish.
The stock market will go first.
No, remember our chart last week showing that they basically happen within days of each other.
Really?
Yes. I'll put the chart in for you. Chart Kid Matt made this for me.
No. But the point is, you only get earnings 4 times a year. Right? There's 4 seasons. So I'm
Yeah.
saying that whatever. That by the time the earnings rear their ugly head, the stock market will have rolled over. Not always, but anyway, the point is this: where a lot of talk about is this a top, is this a top, and again, maybe it is, maybe it isn't, but earnings, that's it. That's all that matters. If I give me one indicator for the future, it is where do earnings come in relative to where do people think earnings are going to be.
Right. Look
I
at
had
look at
this.
the chart I just put in there. Remember this from last week? You must not have been paying attention. It shows that earnings in price essentially top at the same time. They were within.
Wait, hold on. This is. There's two examples here. This is 2007 and 2019.
Yeah, these are examples, but every time in history it's like this, where the earnings and we did an aggregate as well, but these are just examples to show it's within like 12 and 20 days for the last two big crashes that earnings in the stock market roll over.
I need to zoom in because
So the
I'm
point
just
is that the stock market is not going to front run this.
well, how about this? I agree
It's
with
going
you.
to wait. It's going to wait until it sees earnings goes down, like you're saying.
I'm not saying that it's going to front run it by 180 days. I'm just saying, let's say that the market rolls over in February and we start to get earnings in April. That's all I'm talking about. You're going to have like a 50-day window. Close enough.
Okay.
Close enough.
I'm saying history shows the stock market is not very good at predicting tops in earnings.
Okay.
That's what the data shows.
I know. My point is, I wonder how this EPS is calculated because you're using a daily series for the price. This EPS is not a daily series, Ben. That's what I'm saying. The
Okay.
EPS is smoothed out, right?
Right.
There's a time mismatch. That's all I'm saying. But
I get what
close
you're
enough.
saying.
Close enough.
Yeah.
I had this in the doc for our conversation with Scott Nations that we didn't get to, and it's not to suggest that like I was calling for Friday by any stretch of the imagination. But the chart was this: the market has been very calm, and so Friday's hiccup, which obviously we're to get to in a second, things come out of nowhere. Happens all the time.
Yeah, it's been frankly way too easy since April.
Yes.
We hadn't even had a 3% down cycle. We had the 3% down day on Friday. We hadn't had a 3% drawdown at all since April.
So Matt made a chart, the number of days in a row where the S&P 500 has stayed within a 1% trading range. So just really boring stuff. It's been 33 straight days. The last time we had a stretch like that was 2020. Huh?
Well, yeah, probably after the crash.
Yeah, but those are wild times.
No, but if you remember, once the summer hit and started going, it was just a slow, methodical move higher. It wasn't like big chunk.
Okay. Anyway, to your point about the 3% decline. So Warren Pies, this is just delicious for the eyeballs. The market was stretched. Only the seventh 119-day stretch without a 3% pullback. So he plots all of the previous ones. And the strongest ever. So what was the market up? I can't say. It doesn't matter. 119 days without a 3% pullback. So people got complacent, whatever. Friday, Trump tweeted something about 100% tariffs on China. Bespoke has a chart showing.
Sometimes the stock market and investors are looking for an excuse to sell.
Yeah.
That's what Friday felt like to me.
Yeah.
Like, okay, the time. Let's sell a little bit.
Yeah, maybe take some risk off the table. NASDAQ hits a 52-week high and then finishes the day down more than 2% from that high. So it's happened plenty times. I don't know. It looks like around 20 over the past 35 years. Was at the top? I don't know. It happened a million times in the run up to the dot-com bubble. It happened in the recovery. It did happen at the peak of the GFC. But then over the last 10 years, which has been, pretty much up and to the right, few bear markets in between.
Throw these words in my face. There's no way that was the top.
Well, how about this?
It's gonna get crazier.
I agree. It looks like there was 10 of these, give or take, just eyeballing this in the last 10 years. One of them happened at the top.
I mean, even in the 90s, there was a few corrections along the way, but
so everything fell on Friday. We had 424 stocks in the S&P that were down, most decliners since July. What happens next week, next month, next quarter, who the hell knows? But a little slap on the wrist.
It was necessary. Even if a little 7-10% flush here would be perfectly within the realm of like reasonable. We deserve it after what
I love
we've
that
had.
we even have to say that out loud. A 7% decline would be normal. Yeah, obviously.
It just seemed pretty easy there for a while. Can we talk about the AI bubble now? No, I'm
Sure,
kidding.
let's do it. It's been 13 minutes.
There's nothing else to say about it though at this point. So let's move on. We don't need to talk about it. Let's talk about wealth inequality. No,
There's still some new
I'm
stuff.
kidding. All right, where did you get this chart from about market cap weights? Because to me, this shows
This is great. I had never seen it like this.
it
This
goes
is
all the way
Augur,
back to the
Augur,
30s.
Augur Infinity. I can't remember who tweeted it, but they're showing. So the charts that you usually show to demonstrate market concentration are like the top 5 stocks, the top 10 stocks, whatever. This is showing the market cap weight of the top 10% of largest U.S. stocks. And credit to them. This is really great. Going
Okay,
back,
I read this wrong. Okay, I see.
Okay, going back to, I guess this must be the Dow, some sort of combination because it goes back to the beginning of time, and it's the highest ever. It looks like it's like almost 80%. Now, Mobison wrote a piece a year or two ago where he said, actually, concentration generally is what you see in bull markets. Like, be careful what you wish for, because look when concentration bottomed. It bottomed and it declined dramatically in one of the worst bear markets ever, the 66 to 82 bear market. Got as low as 50% or below 50%. And that was treacherous.
So that period in the early 80s and early 90s that's the outlier historically.
Early 80s. Yeah, that was the bottom. 82.
All right, so
which begs the question. Let me just skip ahead a little bit. There's been I got like maybe half a dozen emails last week. Michael, why do you keep saying the stock market, the bear market in 2022 lasted for 2 years? Like, what are you talking about, dude? And fair enough. I think when I say it, I mean like 2 years-ish. It was like almost 2 years. But if I must defend my honor.
Yeah, that's from peak to peak, right? I'm with you.
Okay. But a lot of people are like, what are you talking about, dude? So the stock market peaked on the first day of
January 2021.
No, 2022.
Oh, sorry, 2022, yes.
Okay.
It was the first day of 2022.
And then it bottomed in October of 23. Now, the question is this, and I know this is semantics. And
no, it bottomed in October 2022. We're a couple old middle-aged guys here. It bottomed in October 2022.
Okay. All right, fair enough. My bad. I have the chart right here. What am I doing? Apologies. Top January 2022, bottomed October 2022. Question is, when does the bear market end? And now listen, I'm sort of teasing here. I'm open-minded, different opinions, all good. And I think that this is more of an art than a science, because is the bottom of the bear market, and we've had this debate a million times, so forgive us for rehashing this, but is the bottom of the bear market the beginning of the bull market? I would argue no. Because in March of 2009, nobody was like, hey, look, it's a bull market. And even fast forward to like 2010, when you were already doubled off the lowest, still nobody was like, oh, it's a bull market. Now, I'm sure JC was like, oh, it's a bull market, bro. But does a bull market start when the bear market ends? Does the bull market start when you're 20% off the lows, right? Because like, oh, I guess if you're just using the inverse. Does the bull market start when you're when you're back within 20% of the previous highs? Does that reset the bull market? Does it reset? Does it reset?
It depends.
Okay, so it depends. You're right. So does it reset? Like, let's say you have a 50% bear market. Is the reset when you've recaptured half of the losses? Or does the bull market officially begin when you've retaken the new highs?
Okay, so here's the thing.
So that was my posture in 2013. The bull market officially started in 2013.
For instance.
But there's a lot of room for debate here.
Yes, sir. Like the bull market didn't start till the 1980s, but the stock market bottomed in 1974.
Exactly.
And choppy period after.
And nobody says 1974 was the start of the bull market.
But
right, so anyway,
the market bottomed in 2009 of March and then shot off like a cannon from there. That's the start of the bull market. So it's different. That one for real was the start of the bull market. It's a 16-year bull market.
Okay.
My definition. Other people disagree with me. My definition. This is a 16-year bull market. Just like it was like a 20-year bull market in the 80s.
The reason why I'm even getting close to saying it was a 2-year bear market is because first of all, which market are we talking about? Let's just use the S&P and we can use the equal weight. So the S&P 500 made a new all-time high 2 years after the first peak, right? It was like January to January. Okay? It was January 2022 to January 24. That was the round trip. So that's why I say 2 years. If you look at the equal weight, January 2022, by October 2022, when the equal weight bottomed, I'm sorry, I'm using 2023. So everything bottomed on October 2022. But by October 2023, which is 22 months after the peak, almost 2 years, the equal weight was still in an 18% drawdown. So that's 20 months, 22 months, close to 2 years.
I feel like you're making a case to Judge Judy here in court. That would be a good show, actually. There should be a CNBC should have a judge show where like we hash these debates out.
But 2 years later, the average stock, the equal weight, was in an 18% drawdown from 2 years prior. Is that not a 2-year bear market? I mean, it's close enough. Listen, I get it. There's plenty of room for different
How about
opinions
this?
in here.
Josh can give me royalties in this. We'll have Judge Josh on CNBC. He can wear the robe. He'll have his gavel. And then people come and argue about this stuff.
Because if somebody says, listen, the bear market ends when you make a new all-time high, period, well, that's just their opinion.
There's gray area. It's, yes, but I'm glad you laid out your case there. Okay. Chart from Charter. I feel like there's a lot of stuff in America that we get wrong that we're really bad at, and people are very good. You mentioned last week all the negativity. I'm trying to be positive here. There's a lot of things that you can point out that we're bad at. The education system's not great, and we do this wrong. We're not good at this. We're really good at producing the world's best companies. So they have the world's 100 largest public companies. We have 60 of them, okay, in North America. There's 2 in the Middle East, 17 in Europe, and 21 in Asia Pacific. The rest of the world has not figured out how to make gigantic corporations like we have, right? We're really good at that. For all our faults, we're very, very good at this.
Very, very good.
And I don't think that's going to change anytime soon.
All right. One thing in AI. Sorry, too. Look, this is the updated chart.
You did this, not me.
From Goldman on.
I tried to keep this an AI-free podcast because you complained last week. Hyperscaler
CapEx for AWS, Microsoft, Google, Meta, and who's that new symbol? Is that Oracle?
I think people are running out of ways to show this chart differently.
Yeah, but look at this.
we've shown a variation of this chart once a week for 2 years now.
Yeah.
Right? I'm starting to come around to your side. I can't believe you put this in here. Shame on you, sir.
I know, my bad. So another one from Goldman. And we've done this in the past, but sorry. Valuations today compared to the tech bubble, the Japan bubble, the Nifty 50. And if we're just looking at the 24-month forward PE, 27 times today versus 52 for the tech bubble versus 67 for the Japan bubble versus 35 for the Nifty 50. Here's the thing as we mentioned earlier. 24 months, I mean, we don't know what's happened in 24 months. It's number one. Although it just shows you that the expectations were way higher. We're way higher in those previous periods. But the big obvious thing that is so different today than the prior episodes is the size of these companies. These companies, the giants today dwarf the size of the previous bubbles. Dwarf.
So did you catch Howard Marks on CNBC yesterday?
Nope.
He came on and he said, listen, I don't see signs of a mania. Obviously, there's overvaluation. And he's like, these companies are just bigger and better than the companies in the past. That's it. That's my whole, that was his whole thing. It's like, they're just better companies.
Yeah, that's what, I mean, I agree.
I'm looking at the Nifty 50 here. I just have to say, who do you think came up with the name Xerox? Do you think that someone said, hey, I bet you can't come up with a company that has 2 X's in it? And someone said, oh yeah? Like who would come up with that name today?
Hey, that was a winner in Scrabble. Although were there 2 X's in the Scrabble board game? I don't know. But speaking of board games, Kobe is obsessed with Monopoly.
Okay, did you get the kids version or the real version?
No, the real version. And we've played it for 4 straight days, and he's gonna be the Monopoly man for Halloween. And I see no signs of it slowing down. This is my new.
Because I got my kids. Because I think real Monopoly it's so tedious and long. So we had the kids version, which is way faster and way easier.
All right, I love Monopoly. So I have no problem. It's not that long.
How many times have you started a game of Monopoly and not finished it? I feel like that's 75% of Monopoly games is like, screw it. You're going to win. Let's not finish. I've never finished a Monopoly game.
Not me. Big Monopoly guy. The game's usually, it's just, For the two of us, it's 30 minutes or less.
Okay, if you want to bring Logan in, get the kids version. The kids version is actually kind of fun. We play that all the time too.
Okay. All right, here's another good one. The top 500 median stock free cash flow yield. This is from Morgan Stanley Research, talking about like debate about whether we're in a 1990s style bubble, and the free cash flow yield would suggest not, at least compared to 2000, where the free cash flow yield got as low as 1.2%. Now it's 3.4%. But
well, that's the difference.
whatever.
Back then, those companies, they didn't produce enough profits and earnings.
This is the chart.
Same
This
thing.
is the chart. The S&P 500 forward PE normalized by profit margin. And this is the key part. In 2000, this thing was double where it is today. And it's actually about at the average of the last 20 years. So the forward PE normalized by the outsized margins. And when you look at that to Howard Marks's point about like, these are great businesses, it looks reasonable.
All right, at this point, Judge Josh bangs his gavel and says, all right, it's not a bubble. Right? You made your case. I feel like you just went through and made your case. This is not a bubble.
It's not a bubble. It doesn't mean that stocks can't fall 50%. That they always can, right? Like, but this idea that there's going to be an 80% washout and these stocks won't recover, I view that as highly unlikely.
Actually, okay, so this guy, this guy, Robert Kiyosaki, I can't quit him. He sold 33 million personal finance books. 33 million. Barry told me this morning. He says, reminder, I predicted the biggest crash in world history was coming in my book, Rich Dad's Prophecy. That crash will happen this year. Baby boomer retirements are going to be wiped out. Many boomers will be homeless or living in their kid's basement. Sad. And he goes through all this other stuff about silver and saving.
By the way, reminder, this guy's been saying this for the last 10 years.
Oh, yeah. Are we sure this is a real person?
Yeah, so there's been videos of him like berating people in the audience. Remember that?
How is he one of the best-selling personal finance authors of all time?
It makes no sense.
I don't get it.
It does. Some things can't be explained.
I came because you said we were being too negative last week. I came with the positive. So here's the two negatives people always say.
To be clear, I'm not pointing fingers at you or I.
I know.
I'm just saying society. And there is a lot of negatives. Tons.
But here's the thing. There's two different ways there's ways that you can make good news look
bad.
And so one of the things is, well, the stock market is going up and that just means the rich are getting richer, right? But au contraire, that's true, but this is from the Wall Street Journal, more working class Americans than ever are investing in the stock market. For the first time, a majority of low earners have an investment account, and more than half of those new investors have entered the markets in the past 5 years. So Americans with incomes between $30,000 and $80,000, 54% of them now have taxable investment accounts. Half of those investors have entered the market in the last 5 years. And this is from a survey from BlackRock. So yes, the rich are getting richer, but the stock market the tide is lifting a lot more boats now. There's way more people invested in the stock market. Among newer investors, 45% has put $5,000 or more into their accounts. 40% of the new investors since January 2020 plan to hold their investments for at least a decade for long-term goals, including retirement. This is great news.
Yeah.
The stock market is going up, and yes, rich people are getting richer, but that's always going to be the case. Now there are way more people invested in the stock market, and people always say, yeah, the top 10% own most of it, but it's close to 2/3 of all American households own stocks now. So this boom in the 2020s has been phenomenal. I think Robinhood has 26 million customers, and I think they said something like half of those, it's their first ever brokerage account.
JP Morgan said something similar in their earnings this morning.
Okay, so listen to this. This is from JP. So the Wall Street Journal had another piece. Now, people have been saying, like, listen, this stinks, the fact that young people are being boxed out of the housing market. And I agree, a lot of them are really angry and probably have a right to be. But they say, where have all the young home buyers gone? Check the stock market. A JP Morgan Chase report found that 37% of 25-year-olds used investment accounts in 2024, up from 6% of the age group in 2015. A six-fold increase in the number of people investing in the stock market over the past decade suggests a shift in the way people think about building wealth. So they're saying, listen, most of the Gen Z people who are boxed out of the stock market or the housing market are using those down payments to invest in the stock market, as we have been saying. So the numbers now bear this out. There's way more young people invested in the stock market, and there's way more low-income people invested in the stock market. Both fantastic leaps forward in household wealth, right? This is very good news.
You mentioned earlier how good we are at producing these giant corporations. One of the side effects of those giant corporations is wealth inequality. and it is a real issue, and it is a political issue, and it is a societal issue. Obviously, the way that these rich people can impact the conversation, the elections, it sucks. And I think we all agree it sucks. But there is the other side of it, which is the rising tide lifts all boats, not every boat. But somebody had a good email on this topic. They said, I don't think wealth inequality matters. I don't think wealth inequality matters. Okay. Well, do they really mean that? I would think it does matter. All right, whatever. They said, or maybe I'm misquoting that. I don't think wealth inequality matters. Okay. But the absolute level of wealth for the bottom X% does. If Elon Musk sold all of his stock, withdrew all of it in cash, and set it on fire, inequality would go down. But it wouldn't make anyone's life better. Conversely, if Elon's wealth goes up by $10 billion tomorrow, it makes no one else's life any worse because we are not in a zero-sum game economy. Wealth inequality will never be better than it is today. Oh, I wrote this. Wait, did he write this? I'm sorry. This is a horrible red email. One of the worst. Put this in the Louvre. Wealth inequality will never be better than it is today because of compound interest. Sure, a bear market will make it better, but who gets hurt worse in a real bad recession? Elon or the bottom 10%? That sounds like him, not me. Fair points in there.
Are you arguing with yourself and ChatGPT?
I don't know. I don't even know. Did I make this up? Did I write this? Did I write this myself?
Here's the great thing about the corporations. You can now invest in all the corporations for pennies on the dollar in an ETF or a mutual fund or whatever, and own these corporations and take part in their profits of their growth. That's the beauty of the stock market. It's a miracle.
And it's funny.
People don't make a lot of money have the ability to invest in multi-trillion-dollar corporations and all their growth and earnings.
It's amazing. You could literally own NVIDIA.
Right?
And for all the hoopla over private over alternatives, which we're going to get to later. I'm in the penalty box. How many times have I said which we're going to get to later in the show? I think this is my third time. But why would you want an alternative to Apple or Amazon or NVIDIA?
That's a good question. What percentage of investors can pronounce NVIDIA correctly?
I think most do. Sometimes you still get the NVIDIA, but I'd say most are.
Yes. When you catch one of those, it's like Chipotle. When people can't say Chipotle.
Chipotle.
I went to Chipotle today.
It grinds my gears. Did I say that I went to Chipotle recently? And I think my bowl is $12.65. Are they back?
You did say that. You said you're back. Deflation.
Stock looks okay. I feel like the stock might be bottoming, this piece of garbage. Where are we next, Ben? We've been jumping around.
You got this one. You said fiscal stimulus was a hell of a drug.
Now, we're not going to fix wealth inequality, but the baby fund stuff is great news. That's great stuff. And it really is. You got to be in the investor class, right? That's it. And I think nobody likes the K-shaped economy. Like, obviously, we wish for more people participating in the upside of the economy. And the way to do it, it's through assets. Because the people that are investors have so much money because of the bull market.
Yeah. And that money's going to keep growing because those people aren't forced sellers. Most of those people who have the assets are not forced sellers.
So anyway,
this is why Robert Kiyosaki is not going to be right about baby boomers being homeless. The ones who own all the stocks, they're not just because of bear market hits, does not mean they're going to be forced to sell their assets.
By the way, we didn't even read the rest of the tweet, which is whatever. We'll put in the show notes if you really care. But like it was crazy.
That's what I mean.
Buy silver and Ethereum because everything's going to crash. What do you think is going to happen to ETH in a global depression?
Whatever. All right, what's this flows one? Because this Treasury bill ETFs have the biggest flows this year.
There was a lot of throat clearing. My point was there was so much money in the system that the year-to-date category ETF flows, the top 4, it's not everything we're talking about. It's Treasury bill ETFs. Okay, crypto isn't there. It's precious metals, it's the value factor, and it's thematic funds.
I would have never guessed T-bills are the top category
by
for
a
ETFs.
Lot.
In a million years, I never would have guessed that.
By a lot. All right.
It is funny, the value stuff. So we have a talker book coming out next week with Victory Shares, and they have these value momentum ETFs. And we talked about how momentum has been outperforming by a wide margin over the value factor, but there's way, way more money in value. And look at it. I can't believe, so value is the 4th biggest. People cannot quit value investing. Money just keeps flowing in there regardless.
How much? $36 billion. Where was momentum? 12. So yeah, checks out. All right, this is weird. I'm not sure what to make of this exactly from Deutsche Bank via the daily chart book, which is just a go-to every day, all day. The key story for September was not rising positioning, but booming fund inflows, not just into equities, 122 billion, but also bonds, 98 billion. Indeed, the combined inflow in September was the largest monthly inflow since early 2021.
So the bond thing is, I still think baby boomers repositioning and rebalancing.
Yeah, that's explainable. It's just so much money.
Everyone has money.
All
Well,
right,
this is good.
let's get crazy. Also from Todd. He has the ETF asset class launches as a percentage of the total on a rolling 6-month period. I don't know if it's an underappreciated story in the stock market. But if you're not like online and really into it, you might be missing the plot here. The leverage and the degen economy, as Lindsay calls it, just continues to plow ahead. So over the last 6 months, 1 out of every 4 new ETFs involves using leverage.
People really want this stuff, huh? See, this is why people need a slap on the wrist. Like this kind of stuff getting out of control is like this is why we need a little more than a Friday flush eventually. And it sounds like crypto. I'll do a year. We're going to talk about that soon. But
I think that it's such a small piece of the market, even though the numbers are gigantic in terms of the market caps of a lot of these companies, and the call options are on a relative basis. Does it matter?
No, I guess not. But it's an interesting trend that there's just way more leverage in the system. And there's a lot of people who, like Corey Hoffstein, has been pounding the table on this for a while. Like, there's ways to use leverage very intelligently, right? And I'm obviously sure. A lot of people, most people aren't probably. They are being degenerates with this, but people are obviously more comfortable with it and they want this stuff. Otherwise, there wouldn't be all these new ETFs. All right, I want to talk about one of the beautiful things about markets. Like, you can still, I've talked about this with Bitcoin before. Almost everything that Bitcoin and crypto people have told us, have predicted about the world and what will happen has been wrong, but they all stayed long and they still made money. And I think a similar thing is happening with gold, okay? Everything the gold bug said would happen. The dollar is going to crash and the Fed is going to ruin everything and the financial system is going under. Everything they said was wrong for most of them. And they're still being wrong about why gold is going up right now, which we'll get to in a minute, but they stayed long and they made money. Right, gold's up 50% this year. So, I showed this chart last week on Asset Compound. Do you see this one? It's gold and S&P by decade, and in every other decade, one has been up really big and the other one's been down, or like the relative spread has been wide. The 2020s are the first decade in modern economic history that gold and stocks are both booming at the same time. Never happened before. It's kind of surprising, right?
Yeah, that's good. That's good stuff.
But then all these people. I tweeted this and some guy said, measured in gold, not dollar terms, isn't the S&P down 16% or something since 2020? And then I see a chart from Bloomberg. Denominated in gold, equities have been falling since 2000. A chart from Goldmark chart. Ounces of gold to buy a new house. Median new single family home priced in gold is now at all-time lows. This is the dumbest thing I've ever. This is so dumb. You cannot price speculative assets in speculative assets. What if we price gold in S&P 500 points? Guess what? Gold is not up 50% in S&P 500 points. This is the dumbest thing I've ever heard.
Gold.
People, stop this. This is dumb.
Price gold and Oklo. What are we doing here?
Exactly.
Gold's crashing when you price it in Oklo.
I just, listen, take the win. If you own gold, you're long, you've made a ton of money. But the reason gold is going up is not because of fiat dollars or something. Someone tweeted the other day that gold makes up 3% of the world's currencies or whatever.
People just take it too far. Central banks are buying a lot of gold.
That's the thing. Central banks are buying gold. That's why it's going up.
And there is uncertainty, political uncertainty, economic uncertainty, dollar uncertainty that is leading gold higher. But you don't have to then price the S&P in gold, right? You're most a lot of the thesis is. It's not all wrong. A lot of it is played out. But then you go crazy when you're pricing. Why not price cattle in gold? I mean,
That's
what
the
do we?
thing.
Yeah,
Yes, just take the win. Take the
when
win. You
I
don't have
sell,
to make it crazier.
if you want to sell your S&P 500 index fund and take that money to the bank, you're going to get dollars. Like your bank will take dollars. You could pay your mortgage with dollars. You can't pay your mortgage with gold. You price it in
Yes.
dollars because that's the unit of
You don't go to your local
economics.
brewery and say, "Here's a gold coin, sir."
Yeah.
Fill my beer mug. No.
Wait, what do you
doesn't
mean?
work
My
like
gold
that.
coin used to buy me 3 beers, and now my gold coin only buys me 1 beer.
Yes.
What's going on here?
And the
What are
bartender's
you-
going to go, "I don't care. Get out of here, weirdo."
It's bizarre. It's bizarre. Here's this. This is also bizarre. We've spoken a lot about like measuring sentiment, and having conflicting reports, which is why I think like a lot of the work that JC and his crew do about like building a composite sentiment reading is the best way to do it. I don't know what's in here exactly, but Goldman Sachs Global Investment Research, US has a US equity sentiment indicator. Now, again, I don't know exactly how they're measuring it, but like based on this, it looks like nothing to see here. I mean, if anything, people are like not excited at all.
If it's based on surveys, then let's throw it out the window because then it doesn't matter anymore. I've said sentiment is broken. The vibes are broken forever. That's my case. All right. Eric Soda at Spilled Coffee has a good one about the cash on the sidelines fallacy. Did you see any of this? So this is one from Charles Schwab, and it shows.
We've made this chart in the past.
Have we? Okay. But this is the whole thing about all the money. I think the 0% interest rates in the 2010s kind of broke people's brains on money markets because no money was going in there at all for the whole 2010s because rates were zero. But he shows it as a total net assets as a percentage of the S&P, and then there's not so much cash on the sidelines because stocks are going up, so cash should be moving with it. And then U.S. money market funds as a percentage of S&P as well. His whole thing is saying, yes, there's $7 or $8 trillion in money market funds, but if you look at it with where the stock market is, that actually makes sense because the percentage is actually going down because stocks are going up. So if you hold cash constant, it's not like that money's all of a sudden going to come rushing in. And I think we mentioned a couple weeks ago, like if a richer society, there should be more cash on hand. It makes sense. Yeah. So it makes more sense than people are saying. And credit to you. You were early on that one saying that this money's not coming out of money market funds. That's staying put. I think you're right.
Is this next chart from Dan Greenhouse the same thing?
Yes. That was in his piece as well.
Yeah.
All right. Here's a good one for you. Households have $1 in cash for every dollar of debt, the most deleveraged since the early 1990s. This is from Bank of America. Households are still in good shape and have the ability to borrow even more money if and when the next downturn hits. I continue to believe that whatever downturn is, unless the AI bubble totally inflates to like epic proportions and then it just pops but even the dot-com bubble popped and the 2001 recession was very mild, extremely mild. It helped that we had a housing bubble to prop people back up, but that's probably what'll happen this time again. We'll probably get a housing boom the next time the economy slows. Anyway, I think whatever happens, as long as it's not some crazy exogenous shock, households will be able to weather it by borrowing more money.
You know what's coming around the corner, Ben? We got earnings season, which is my favorite season because as I keep pounding the table on, I care a lot more about what companies have to say than what journalists have to say. A lot more. Companies have no reason to.
That's your new tagline. Listen to the companies, not the investors, right?
I'm not gonna say they're not going to lie to you because there's some companies that do some shenanigans, of course, but on balance, companies are not incentivized to not tell you the truth. Now, again, sometimes they cover stuff up, is what it is, but they're not going to paint a rosy scenario in the aggregate when the facts don't warrant that.
But this
they're
is
going to call
why,
it like it is.
This is also why, as someone who's a long-term person, a lot of people email me and ask for my thoughts on if we shouldn't have them report quarterly anymore because I'm a more long-term person. But I actually totally disagree with that idea. I think we need to have them report quarterly because I think opening it out longer opens up the possibility of shenanigans.
Me too.
I think that's my problem with that idea. Anyway.
Me too. I actually listened to the Delta. I listened to the Delta call this morning. And a few things in there stood out. Delta is now 60% of the industry's profits. Kind of wild. They're killing it.
I mean, they're by far the best airline. It's not even close, right?
Not even close. I only
Did I
fly
tell you
Delta if I
about
can.
the last time that I do too? And I have one of the Platinum Delta credit cards, and it's the only one I fly usually. And I was on a flight with my kids. Where were we? I can't remember. The last time we flew as a family, and the flight attendant came up to me, and I felt kind of like George Clooney on Up in the Air. And they said, "Hi, Mr. Carlson. Just want to thank you for being a Delta Platinum, blah 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 blah, and being so loyal to us as a." My kids are like, "What was that about? Are you like a celebrity?" They thank me for being a
On my flight home from
loyal member.
Austin, not to brag, the flight attendant came up and shook my hand and said he's a big fan. So I forgot his name, but if you're listening, thank you, sir. That made me feel pretty good.
He sneak you a free drink?
I've been drinking on flights.
Okay.
Credit to me, because who doesn't love drinking on flights?
Getting a drink on it. I feel like what percentage of people in first class get a drink when asked when you get 80%?
I almost always do, but I haven't been doing it because busy. Responsibility. Growing up.
What's this
all right, what
chart?
else was? Wait, what? Hold on, one sec. They also said that corporate travel is all the way back, higher than 2019 levels.
See, that's the one I never would have thought. When people were predicting how the pandemic is going to change the world forever, I would have said, yeah, with Zoom meetings and such, corporate travel is never going to get back to the same levels.
Same. All right, so this chart shows
I think that there's some people in some businesses that just, they like the face-to-face interaction, but I think some people just love that lifestyle. Being on the road, right?
The road.
The guys in the polo shirts and the jeans and the boots, right? Those guys have to be on the road, drinking their Miller Lights at the bar and, talking about the Astros or something.
So the premium cabin revenue is about to pass main cabin, which is pretty wild. And Glenn Howenstein, who's the president, said, I've equated it to this. The car that you drive today, is it better than the first car you had? The answer is probably yes. And you don't see many people going back to cars that are worse. Once people get used to traveling a certain product, whether it's Comfort Plus, Delta Premium Select, whatever, they tend to not go back. Their retention rates are in the mid-80s there. So, yeah.
Well, that's true. They didn't have Comfort Plus and stuff in the past. That's a relatively new thing.
Luxuries become necessities.
But I'm sure that they're also able to jack the prices up on those and people will still pay them. People who have more money, right? I'm guessing that's part of it.
Yeah,
it's like the IMAX experience.
Somebody emailed us about going to Disney, and they said that Disney's charging $200 to meet Santa or something like that. Listen, people will pay it, whatever it is. But I did say to my wife, we're not doing the meet and greet with the characters this time. What a piece of shit sham that was. You get this crappy buffet. No, we're really not. We're really not. That's it. You get this crappy buffet for $130 a head.
That is one of the worst things about Disney. The food is awful. I don't think they care really, but the food is not good at Disney, right?
No, not
also,
great.
My wife got after me a little because I said I didn't want to go to Disney on a podcast a couple weeks ago. Apparently, she still listens to the show occasionally.
Are you going?
I stand by my take. Yeah, we're going in Thanksgiving. Every week she calls me. Hey, you want to do this at Disney? I'm like, I don't know. You take care of it.
Wait, Thanksgiving at Disney? That's a great idea.
Yeah, we thought so.
All right, let's talk gambling. This is a great tweet from Dally Bally 2. So on Friday, as the market was having a not so great afternoon, was Akla positive on the day? I think it was. Yeah, it was. This guy tweeted, I was wrong. Akla is the perfect stock. No revenue, no product. Hence, no exposure to anything.
If I'm being honest, I have no idea what Aklo does.
They're trying to build a nuclear energy something.
Oh, well,
I think that's what they're doing.
That shouldn't be that hard.
All right, so this was making the rounds. The Goldman Sachs basket breakdown year-to-date performance, and they also break it down by the April 8th to today. All right, drone stocks are up 370%. Quantum computing stocks are up 315%. Memes are up 123%. Non-profitable tech is up 111%. Most short are up 98%. So retail is kicking the shit out of professionals. And I got to say, like,
using all degenerate themes for the most part.
I'm not mad. I'm not wagging my finger. Yeah, but I think most people understand that, like,
you don't think there's a lot of hedge funds in these trades now too, though? Just
probably the smart ones.
This stuff. Yeah,
the smart ones are.
All the momentum traders are in these stocks.
And you know what? If people
It's
get
not
wrecked,
just
they get
retail.
wrecked. This is the market, right? Like no
Yeah.
crying in the casino. And also, if I was a younger man, I'd be balls deep in these names. Come on now.
Okay. I wouldn't, but
Now, I know you
good for
wouldn't.
people who are. Yeah.
All right. So last week, I believe last week I said, or maybe 2 weeks ago, I said, the market is cruel. Like, even if we know that a lot of these names, and I guess we can't know, but even if we strongly suspect minus 900, that the odds are against most of these companies sustaining their valuation, it doesn't mean that the shorts are going to make money. It's just not that easy. So credit to
I
this
can't
guy.
imagine wanting to short this stuff and like get in front of the train and time it perfectly. No way.
I mean, I can imagine it. If you really understand the businesses here and you genuinely know that these are pieces of shit. Now, I don't know that, but if you are one of these people that have domain expertise,
Yeah,
and
but
you could
using
say,
a fundamental thesis in a mania is, come on.
no,
The
dude,
timing is all that matters there. And you
I get it. 100% right. Anyway, my point is I want to shout out this one guy. Credit to this guy. At Common Sense Play, tweeted, I'm closing my short on Ionic and Rigetti. Market makes no sense. They will drop 90%, but taking the L on this trade. That's a pro move.
Yeah, good for him. Good on him for admitting it, right?
Yeah. The market just won't let you make money this way. And maybe the longs will get liquidated, but the shorts definitely will too. That's just the way it goes.
All right, let's talk about crypto. I am a tourist here, but it sounds like on Friday people were like brought out in body bags from crypto, and it's weird because Bitcoin was down, I don't know, 5 to 10%. Ethereum, it wasn't like a huge crash.
Hold on. The Ethereum and Solana were down at one point. I think each more than 20%. The altcoins fell. Some of them fell like 90%.
That's what it sounds like. It was the altcoins
Yeah.
and stuff. But it says the biggest crypto liquidation ever from CoinDesk amid market chaos. And they talked about all this stuff. And people were trying to figure out, and they say it was 20 billion, but it was probably way higher than that because of Binance and all this stuff. And a lot of people were pointing to this old post from Brian Armstrong from Coinbase at the beginning of September. He said, we just bumped up the max leverage from 20 times to 50 times on international perpetual futures. A bunch of traders asked us for this update. Let us know what else we can add. I don't know if that was the reason, but it sounds like a lot of people were just extremely over-levered, and it didn't take much of a fall.
Yeah, that was the reason. It was leverage.
So it was just an insane amount of leverage, and people got taken out and bought. There was literally one down day in the stock market, and it evaporated crypto. But I guess, and a lot of people are saying a lot of these altcoins like literally went to zero.
Yeah.
And
but
this
it is wild that
is
Bitcoin at 110,000. I mean, it's still a healthy number. And yet, look at this chart from Wall Street Journal. They show the total liquidations on crypto derivative exchanges. It makes the FTX, I mean, you can't even see it. This was 19 billion, FTX was 2.
So there must have just been an insane amount of leverage in the system. And this is a good thing. No one, you talk about no crying in the casino, no one should feel sorry for these people, but it sounds like people were up millions and millions of dollars and probably lost millions.
Okay, you could simultaneously feel bad for people, like it sucks that this happens, while just being a human being. Like I'm sorry that happened to you, while also saying, what did you think was going to happen?
Come on, yeah, exactly.
Right?
If you make millions of dollars going 50 times leverage, you can go to zero on the same thing. I think that's just.
Could you imagine being? I'm not laughing because it's not funny. Being one of those people that got wiped out from the Trump tweet, and then 24 hours later, Trump says, "Don't worry, it's all good with China. We're gonna make it. It's gonna be fine." I mean,
yep, Taco Sunday. I don't know. It's the whole thing Warren Buffett said before. You don't want to get rich twice. If you got rich once and you made $5 or $10 million in crypto, I don't know. Cash some of it out.
Hopefully, there are people that saw this, younger people, because it's always younger people. Eventually you do this long enough, you get burned. Hopefully, young people saw this and said, "Okay, maybe I should rein it."
But it's insane to me that people were able to put 20, 30, 40, 50 times leverage on and make that much money. And at that point, it's just a game. It's not even real life.
Yeah. Well, you know what? Somebody tweeted, long-term capital management was using, I think, 25 times leverage, and they got wiped out doing fixed income arbitrage.
Right.
I mean, they're talking basis points. You're using 50x leverage on crypto? I mean, come on. Use your head. All right, let's talk private markets for a second. BlackRock reported this morning, I think they brought in $8 billion in private credit. It was the largest private asset investment gatherer that they reported. Lots of demand. So they had a report a week ago. Today's private credit opportunity, and I think I'm on the record. At least I'll go on the record. I don't think private credit is a bubble. I don't think that First Brands blow up is indicative of everything. I'm sure that there are, that it's not the only one, but I don't think it's like a systemic. All private credit is a fraud. It's going to blow up the system. I just don't.
As
don't
the
buy
space gets bigger, there's going to be more blowups. Like there
Correct.
has to be, because
Correct.
it's casting a wider net, and there's more businesses and there's more loans, and of course, so the stories about private credit are going to be amplified because people have been warning about it.
Yep, no doubt. And there's a lot of journalists that are dying for this to be a juicy, salacious story. And the First Brands one is, and I'm going to talk about it tonight with Josh. But this chart made me laugh. Private credit assets offer a unique correlation to the public markets, and they show the correlation of the Preqin private credit versus the Bloomberg Ag, and they show it at negative 0.02. Come on. How is this negatively?
If you don't report the NAV, the correlation is 0.
How is this negatively correlated to bonds? What are you talking about?
Well, it's essentially a 0 correlation, meaning like that's
Oh, by the way, I think I said this last week on the show. I tried bottom fishing in the Ares private credit BDC, and I got stopped out for 5% loss because I'm not that brave. But I think I should be back. I think I'm going to get back in. I don't believe that this is going to be like the unwind of the century.
Okay. Good luck with that. I my whole thing is just, I think people need to just temper their expectations with private credit. The returns have to go down. But even if they go down, let's say returns go down 20% and they go from 11 or 12 to 8 or 9. Is that the worst thing in the world?
No, I think that's probably my base case. If I had to guess what's going to happen, yeah, returns going to be compressed because more money coming in, and that's the story of capitalism. All right, this is a great chart. So we've mentioned this data point: 90% of companies in the U.S. that generate $100 million are privately held.
Mm-hmm.
Right? I've never seen it put this way. Kind of a face blower here. I would have thought that like the 90 or the 80-20 rule applies. That even though most of the companies are private, you still have more revenues with public companies because Nvidia and Walmart, No, not true. $40 trillion in annual revenue for private companies in the US. Damn, that's a lot of money. And $35 trillion for public companies.
So that includes like all small businesses. So like my tailor at the mall right next to my office, Sue Alterations, small business.
Sorry, hold on. I'm sorry.
That includes that?
This is the US, the EU, and the UK.
Okay. It's still surprising.
Right?
I feel like that private number has to be very hard to get, though. How do you come up with those numbers? I'm sure there's a way to back into it. Anyway, yeah, you're right. That's surprising. All right, Bloomberg has a great piece on what I think is called House Rich. America is minting lots of cash-strapped millionaires. So they say millionaires are on the rise, but much of their wealth is in hard-to-reach assets. This is funny. In the Gilded Age, there were 4,047 millionaires in the U.S., and each one was listed by name in a special edition of the New York Tribune. Can you imagine that? Like they listed just all the millionaires because that's how in the paper. Today, the millionaire households more than 24 million, 1 in 5 U.S. households. And a third of those modern millionaires have been minted since 2017. But they're saying it's mostly in houses, right? For the barely millionaires, people with $1 million to $2 million, 66% of their wealth is tied up in their primary home or retirement accounts, meaning it's illiquid. They can't access it. Households with $5 million or more had 24% in easy to access bank or brokerage accounts, compared to 17% for those closer to the millionaire mark. So basically, it's saying a lot of people have $1 million, but they're probably house rich, retirement account rich, and they can't really. It's not liquid net worth. To which, I mean, play the world's smallest violin for these people. Obviously, you're still a millionaire, but obviously that makes sense since housing is up so much. There's probably a lot of house rich millionaires. And housing really is one of the hardest assets to unlock, the wealth, right? You have to borrow against it for a HELOC or cash out refinance if you want to take some of it out, or sell, and then you have to live somewhere. So you have to either downsize or buy a place that's just as expensive, potentially. It is the hardest one to actually unlock the wealth. Anyway, being house rich. First world problems, but that's the thing.
Yeah.
House rich millionaires. Right. They said Gen X added the most millionaire household. This is funny. They look at all these increases in millionaires. Gen X added a ton. Millennials added almost like 3 million millionaires. This is since 2017, so a huge leap forward, right? But then they show being a millionaire isn't the same as it used to be. And they show the cost of a 4-bedroom home in the New York suburbs, driving 2 Mercedes E350 sedans, which I don't know what that is, oh no, those are, a 4-year Harvard education for 2 children, and a 2-bedroom upstate New York cottage, and a 19-foot Sea Ray boat. They show the difference in the cost. I'm sorry, this is not being a millionaire. This is being like a deca-millionaire.
Yeah, what?
So you own a house, and you own 2 Mercedes, and you send your children to Harvard, and you own a 2-bedroom cottage in upstate New York, and a boat.
Dude, this is the thing. This is the news that they're giving us because we're outraged, right? We're outraged. This makes people mad because it's nonsense. It's pure bullshit.
Right. This is the top, I don't know, 5%,
Who
3%,
lives like this?
2%. Yeah, this is not a thing that just being a millionaire did not used to, it never got you this.
Mercedes, a vacation house, a Sea Ray, Harvard.
Right. Sorry, that's not being a millionaire, right?
That's being in the top. That's like top 1%.
Yes, exactly.
All right. There was a long article,
and that's why even rich people are a millionaire, because they look at that and they go, "Why? I'm rich. Why am I not doing this stuff?" Right. Because that's very few people do that.
There was a long article in the Journal about how not great Hollywood is doing. They said at the end of 2024, 100,000 people were employed in the motion picture industry in LA. 2 years earlier, it was 142,000. 30% fewer movies and TV shows with budgets of at least $40 million began shooting in the U.S. in 2024 than in 2022.
See, this is surprising me because there's so many more streaming networks now. I would have thought it would have risen for sure.
And yet Hollywood still seems so not great at giving the audience what they want. Like, for example, Tron opened over the weekend and it bombed. I'm not surprised. It cost $180 million to make. It did $33 million at the box office over the weekend.
My son wants to see that really bad. He watched both the first 2 Trons.
He did. Okay, fine. So George is an outlier, but I should be a consultant. This is so easy for an outsider. Now, easy in the cheap seats.
Yeah,
but
no one wanted that one.
Michael, are you going to see Tron? Nope, and nobody else is either. Good, done.
Right. That should have been a straight to Disney Plus streaming movie.
Tron is not this is not IP that anybody gives a shit about. Give people more weapons and sinners. Like, get the memo. It's over.
You will be going on the Tron ride at Disney, though. Mark my words. Supposedly they could have a good Tron ride.
But the problem is when these things bomb. Scott Mendelson was writing about this. They blame the audience doesn't want to see movies. No, we do want to see. We want to see good movies. We want to see this shit.
Right. Again, that should be a straight to Disney Plus movie. Like, they should have more of those as opposed to trying to be in the theater with that.
Absolute junk. I got a lot of emails last week about spending less time on your phone. And a lot of it was like, delete the app. Come on, guys. I don't have the app. Think I'm that big of a dodo? What I do is I go on through the internet.
See, that's even worse than the app.
But somebody did send me something
that's an addict move right there.
To go on through the internet. But I only go
hiding the drugs in your ceiling or something.
I bought something called a brick. I haven't used it yet. But I think what this thing is I think it like restricts websites. So you have to like physically hold your phone to the device to unlock it. So I'm going to literally cut my phone off from Twitter.
You know what I finally did?
And again, I was thinking about this week because after reflecting on the show last week, I really am only on it during my downtime. But the problem is my downtime is when I should be with my kids. So I'm on the couch at like 7 o'clock or 7:30 scrolling Twitter when they're like, on their iPad or whatever. It's horrible. It's like the worst thing ever.
You know what I did that helped me a lot on Twitter? And obviously, to your point, willpower alone is not enough. In these instances, you need to have some guidelines. I don't have
willpower.
One of the things I still use it for is I'm catching up on sports, college football or NFL, because I'm out and about doing stuff all Saturday and Sunday with my kids, and I'm watching highlights. But then you have the auto video feed, and it goes from like a sports highlight to like two dudes fighting in an alley.
Yeah.
And it's like, I don't need to see this. So you can turn off the auto video play. So it loops your video. So it doesn't show you these other insane videos that you don't want to see, and you get caught on the loop. That's helped me stay off of Twitter more. Like I'm just watching it for sports highlights and nothing else.
Well, you do have willpower. I don't need to be off Twitter completely. I just need to be off it from like the hours of 6 to 10. Because during the day, whatever. All right. Anyway.
Yeah, you're too busy to do it during the day.
All right. Here's a good one. Talking about like the news and what we see and what causes all of the anxiety. Max Roser showed.
Oh, this is a good chart.
It is great. All right. What Americans die from and the causes of death the media, the US media specifically, reports on. So, for example, heart disease and cancer are the number 1 and number 2 killers. They're almost 60% of deaths, almost 60%. And yet they are 6% of coverage at the Times, the Post, and Fox News, give or take. 60% of deaths and only 6% of coverage. On the other hand, the biggest by far, because it's salacious, is homicide, 42, 46, and 52% on the networks.
It is kind of crazy. The causes of death, homicide, you can barely even see on the chart.
I don't even, what is it? Is that 1%? I can't read it. It's so small. Terrorism, 18, 12, and 11. And that,
I mean, to be fair to the news networks, it would be kind of weird if they're like, Jerry Smith died of a heart attack today at age 73. He was 250 pounds and
100%. Drug overdose.
But you're right. This is a very good put it in context kind of thing.
Even on like local news, and even like Good Morning America that Robin watches, it's always just like, oh my God. It's like,
I can't.
Death hit by car.
It's too much. I pretty much just avoiding cable news has been probably better for my mental health than even Twitter. I stay away from it at all costs. I want to give a shout out to our colleague Tadas Escanta. Celebrated his 20th anniversary at Abnormal Returns, which is absolutely amazing.
Amazing.
The best curator in all of finance. I still like every Sunday he does the top 10 posts of the week. He has personal finance posts. He has an advisor newsletter. Every day he's putting out the best links from everything. Like people ask me like, how do you have a filter in place to read the best stuff and stay up on this stuff? And I said, whatever you do, just read Abnormal Returns every day, because he doesn't miss anything.
Congrats, Tadas. That is impressive. Wow.
20 years of doing anything is amazing, but think about how many people that when we started blogging back in like the early to mid 2010s, there was all these other people who had blogs. Think about how many of them have fallen by the wayside and just stopped doing their blogs. And like the fact, like survival is a big piece of it. Just keep doing it. All right, recommendations. I will start. You got me going on Audible books, and now I'm hooked. And it's got me to the point where I don't listen to podcasts as much. Like, I'm like, why do I need this stupid pop culture sports podcast? So I listened to Breakneck by Dan Wang. He's been in a ton of podcasts. Yes.
Wait, I thought I put this in here.
Oh, you did? No, I put this in here. Did you listen to it too?
Dude, it's so good.
Okay, it's very good.
Wait,
I finished it in like a week.
Look at us. How old are we? We're listening to the same audio book and we don't even know it.
I listened to it in a week. I finished it. I just thought his whole thing about when he first said the lawyers versus engineers thing, I thought like, oh, that's clever. It's cute. But he really like point by point kind of broke it down. Like, okay, so
wait, hold on. Just for the audience, because you're right. That hits so hard. Explain what he meant by that.
So the whole idea is that the United States is run by lawyers, right? Almost all the politicians, like 2/3 of them went to Yale Law School or Harvard Law School. And all of our politicians are lawyers, and they put rules in place to make things like protect people and make sure things don't happen.
Yeah, you can't do anything.
And yeah, you can't get anything done. And China is run by engineers. They build stuff. And I thought the greatest thing about this book is that I thought he did a wonderful job of looking at the cost and benefit of the pros and cons of each system. And he looked at the great things China can do and how they can build stuff, these bridges and like the infrastructure and everything is clean, all these parks, and it's amazing. But they seem to lack common sense. I think that was what he was getting at.
A bit of humanity.
Yes, and I thought that I don't think enough, maybe in the 80s and 90s they talked about this more. I don't think enough has been made about how batshit crazy the one-child policy was. Like, are you kidding me? And the fact that I didn't realize they literally have a department called the propaganda department. I thought he was joking, but that's literally the name of a department. So anyway, so did you come away reading that book or listening to it feeling better or worse about like us versus China in the years ahead? Because
I'm not done with the book, but I feel like I'm in it enough that I can conclude that it's going to be tough to beat them. Those
But here's
those
the thing,
people are.
they can build stuff. Like if we went to war with them, their production, they would probably crush us, unfortunately. But I feel like they have a lot of blind spots. We do too, obviously.
Yeah.
But I feel like
Well,
they have
I think that
a
was the
lack
point of
of
the book, is
common
that
sense about.
we can learn a lot from each other.
Yes, I think that was the point, that like but we're mirror images of each other, kind of. Like the fact that like we need us and we need us and they need, I can't even say it. We both need each other. And because they like to build so much and manufacturing is such a big part of it, like that, the fact that we're consumers, like we're kind of a yin and a yang with each other.
Yeah.
It's a very, very good book. It's the best. And I'm admittedly a macro tourist on China, but man, it was a good book.
Yeah, it's really, really
That was the
good.
best book I've listened to in a long time, or read, whatever.
Yeah. No, but
Can you say you're
listen,
reading the book if you're listening to an Audible?
they're tough. They're a tough competitor.
What do you think?
I don't know. What else? I'm listening to a book. I know it sounds weird to say, but listen, I think you've come to terms with where we are in life. It's so funny.
I
Reading the same book.
got a show it's very good. I listened to the whole thing in a week. I got a show. The Lowdown on Hulu with Ethan Hawke. It's a good, not a great show, but they basically just said, Ethan Hawke, we're gonna let you cook, and he's like way out there. He's doing all sorts of Ethan Hawke thing. He plays an investigative journalist who gets caught up in this crazy scheme and mystery, and it's not like a prestige kind of show. It's a little silly at times, but it's just, if you're an Ethan Hawke fan, that's all that matters. It's just Ethan Hawke cooking.
I get Ethan Hawke and Jude Law confused. The names, not the faces. I'm not sure why, but
They both anyway, came with the same. You've seen Gattaca with both of them in it, right?
I've never seen Gattaca. I know you like that movie.
Oh, really? You have to watch. That's a fantastic movie.
Okay. I enjoyed the shit out of Black Rabbit. I finally wrapped it up. I really enjoyed it. Right? Yeah.
But it's just a lot of bad stuff happens, right?
Yeah, I think I thrive on misery for my entertainment purposes.
And we're one episode away from finishing Task, and that show has gotten better as it's gone along. The last 2 episodes of Task have been fantastic.
Okay. I'm a little bit behind there. I'm going to catch up. Speaking of misery, somebody said, how come I've never done a favorite horror movie list? I'll do it next week for the Halloween season. But
I thought you did this before.
Have I? I can't remember. I'm going to exclude like Halloween and Scream. I'm going to do stuff that's a little bit more off the beaten path.
Well, that is what you do. Yeah.
Yeah.
How about this? I have a theory though. I think horror movies are the new superhero movies. I think Hollywood is getting lazy, and all they do is do these horror movies at a low budget. I think that's the new, like, let's just do another horror movie.
But you're late though, because that trend has been in place for the last 5 years, and I think it's finally peaking because not A24. Oh my God, who's the dude? Oh, was it Jason Blum who was on Bellamy's podcast a couple months ago? Oh, Megan 2. Bombed.
Okay. I just want more comedies. I don't know why we don't have comedies anymore. It's really depressing that we don't have more comedy movies. It's like no one wants to laugh. I don't get why there's not more comedies.
They don't make money. That's it.
I can't imagine that people won't want to go see good comedies again. There's a new one coming out with Seth Rogen and Keanu Reeves and Aziz Ansari, and it looks hilarious. It looks dumb but very funny. I can't wait. I just want more dumb, funny movies again. That's what I grew up on in the 80s and 90s and 2000s. What happened? Hollywood is letting me down.
Happened. All right, so we mentioned Breakneck, which was a very easy listen, because on my speed it was like 4 to 5 hours. It's a 280
what speed do you go?
Well, it depends. If I'm in the shower, I slow it down to 1 times because it's hard to hear. But if I'm on the move, I am 1.7.
Okay, I'm at a 2 now.
Okay.
I'm comfortable with the 2. And every time I take my dog for a walk every day, and put him in on that and listen to it. And I can't believe how quickly you're able to get through a book. I listened to the whole thing in a week.
All right. On the flip side, though, this book took me 2 weeks. I've always wanted to read this book, Team of Rivals, by Doris Kearns Goodwin, one of the best historian authors ever.
My dad is like the biggest Lincoln fan ever. He's read all the books, and that's his favorite one.
It's funny. As I'm cleaning out, unpacking my office, this was in a box. I bought the Time, an illustrated history of his life and times. Abraham Lincoln. Obviously, I never thumped this. It's a huge magazine. but I will. But anyway, I listened to the book.
The kind of person who just doesn't exist anymore, right?
No. It was too long. I mean, it was tough. It took me, that took me like 20 hours. I think it took me 2 weeks to listen to. I'm glad I listened to it because I never in a million years would have read it. But on the flight home, I mentioned last week that it's been a while since I saw a movie on an airplane. I said, you know what? I want to watch Lincoln. See what Daniel Day-Lewis is all about. All this Daniel Day-Lewis hullabaloo. And it's not streaming. You have to like pay for it, which I would have done, whatever. But it was on Delta. So I watched Lincoln. Perfect airplane movie because it's a slow drama, and it's
kind of a tough watch. It wasn't that great. I didn't think
exactly. You're not going to watch it on your couch because it's boring. But in the airplane, especially after reading Team of Rivals and having all these characters being brought to life, holy shit, Daniel Day-Lewis. I mean, hot take, he's good. He won.
Yes.
He won Best Actor that year.
And it was a great performance, not a great movie.
You're not going to watch this at home, but I really enjoyed it given the context of the book. Did I learn anything? Yeah. Am I going to forget it all in about a week? Probably.
Biographers, just cut 50% of the junk you put in your books, right? A lot of it's just unnecessary.
A lot of fat, as usual. All right. A lot of fat on the show, you might say. We went an hour 15. Read some bad emails.
I didn't talk about AI at all. You were the only one who brought it up today.
It was pretty light. Pretty light.
Right.
What else is going on, Ben? Anything else? That's about it.
Thanks to the production team, as always. IDon'tShop.com. Do we have any new hats yet or not?
Oh, I don't know.
Okay, we'll look. Animal spirits at thecompoundnews.com, and we'll see you next time.